Today on The Bottom Line, Gary Shilling on the big surprises ahead for the economy and the markets. Alibaba, best performing mega cap stock this year, how high can it go? And lastly, the secret life of male bees. Hello everyone, welcome to The Bottom Line. I'm Henry Blodget. Big thank you to NASDAQ for hosting us here in Times Square. Big thank you to Fidelity Investments for sponsoring the show. We're joined today by Gary Shilling of Gary Shilling & Company. Sarah Silverstein has the rundown on one of the biggest stocks of the year, Alibaba, and as always, we'll talk about the market. One of the best performing mega cap stocks this year, Alibaba, is up 100% for the year. Now $400 billion market cap, rivaling those of the US tech giants. Sarah Silverstein's here to tell us about it and what's next.
Well, a lot has happened for Alibaba lately. They had an incredible earnings report. David Tepper announced a huge $500 million stake in the company. And like you said, Alibaba's up 100%, Amazon's up 30% year to date. And Alibaba's actually starting to close the gap between the market cap of Amazon, which is $464 billion. So I thought it'd be fun for us to sort of look at the differences in the companies and the valuations, because the revenue of Baba is $26 billion over the last 12 months. Amazon's $150 billion. But the operating margins of Alibaba are 33% versus Amazon's 2%. And Alibaba has much stronger earnings growth at 95% versus Amazon, which has been down 77%. So, and I think that one of the interesting things is that Alibaba trades at such a lower multiple compared to Amazon. I think Northern Trust Capital Markets says that Alibaba is trading at 25 times its 2019 earnings, while Amazon is at 65 times its 2019 earnings. And the big difference there is that there's a lot more growth baked into the expected earnings of Alibaba, but that's still a huge difference.
And so, whereas obviously one of the differences between Amazon and Alibaba is Alibaba has a business that looks like eBay, which is where the margins come from. It's much a higher margin business than retailing. Alibaba is in many businesses, and the portfolio managers that I talk to say, look, there's so much opportunity in China and they own so much of the market that there's huge upside. Really? That's the question. Where are we in the market penetration that Alibaba has access to in China? How big can this get long term?
Well, China does have the largest internet population. I think it's over 500 million. So they have a lot there. And what I have seen people talk about is that the competition between the two will certainly come as they both try to get international. And UBS, all of the analysts are pretty bullish on Alibaba. I think 47 buys, 3 holds, 0 sells, very similar to Amazon. UBS says the risk to the share price is very skewed, 2-to-1 on the upside, where they see that the upside is up 56% to $258 a share. The downside is down 29% to $118 a share. So that seems to be the general consensus.
Thank you, Sarah. Great to have you.
Thank you. Today's Fidelity Insight is from Jurrian Timmer, the Director of Global Macro at Fidelity Investments, in honor of the Jackson Hole Economic Symposium this weekend. The first thing that Timmer points out is that the Fed and the markets have very different ideas of what the rate hike schedule will look like. The Fed, according to the most recent dot plot, is showing that they expect one more hike, or consensus is one more hike this year, 3 in 2018, and 3 more in 2019. However, the forward curve, the market is pricing in only 2 more rate hikes, not 7, before the end of 2019. But Timmer points out that historically the stock market has held up to Fed tightening, especially in times where corporate earnings growth is strong. So if you look at the future cash flow or the future earnings of a company, that will be discounted at the risk-free rate. So the higher the rates go, the more discounted the future cash flows are. And that could depress the current value of that cash flow. However, what Timmer is saying is that if you have earnings growth to offset the increased discount rate, that there isn't as much to worry about in the markets.
Market and economy have confounded many economists and strategists over the last 10 years, so it is a great privilege to welcome somebody who got it right before it happened. Gary Shilling of Gary Shilling & Company, welcome. So great to have you. Gary, let's start with the big picture. 7 years ago, when we were coming out of the big financial crisis, you wrote a book called The Age of Deleveraging. The consensus at that point was we were headed for wild inflation because of all the money printing. You said, no, it's going to be different, and laid it out for us. Now we're 7 years into that, so where are we?
Well, I think we're about where I thought we'd be. Yeah, we are in this process of working off the excesses that were built up in the 80s and 90s, and of course then we had the housing bubble and collapse in the 2000s. But it's really a matter of working down a lot of those excesses, plus the fact that we're in a globalized world, which has added another big dimension to the whole thing. I mean, in other words, when you're talking about labor supplies and productive capacity, you got to look at it globally, and there's an awful lot of that out there now. So all these things have contributed to a period of relatively slow growth. In that book, I said we thought we'd have 2% real GDP growth annually until this whole thing was completed, and it's averaged 2.1% so far.
Dead on. And so where do we go from here?
I think it's more of the same until something happens, and that something is probably going to be massive fiscal stimuli. You know, if you look at real income growth, purchasing power in the Europe and North America, there's been virtually no growth for over a decade, and that's everybody. If you take off the top 10%, most people have had declining purchasing power, and they're, in the words of that old movie Network, they're mad as hell and not going to take it anymore. And I think that has resulted in the populism. That's what Brexit is all about. That's what got Trump elected. I think it's putting a lot of pressure on politicians to do something. Now, monetary policy has proved to be impotent. It simply has not revived the economy. We can go into the details on that. But I think it leaves it up to fiscal policy. And I think we will see massive fiscal stimuli. The two areas that I think are most likely are military spending, and with the Republicans in control in Washington, if they can get their act together on anything. But they point to, you know, China building the artificial islands in the South China Sea, and Russia reviving their empire, and Japan getting out from under their post-war neutrality. So I think military spending, and the other, of course, is infrastructure spending, which we obviously sorely need in this country, and that's pretty much backed across the board. So I think any politician who wants to get reelected is probably going to respond to this. So that's that's the one thing out of the whole Trump agenda, which I think is going to happen.
And are you still confident of that, given the seeming inability of the Trump administration and Congress to do anything at all? It seemed like infrastructure spending, as you point out in your latest note, we are at almost record lows of GDP. Our country is falling apart. Everybody on both sides of the aisle seems to agree, time to spend, and yet nothing happens.
Well, we do have an event coming up the first Tuesday in November of 2018, to pick a random date, the next election. And I think that's going to put a lot of pressure on Congress and the administration to get their act together and do something. Now it'll take 2 or 3 years for infrastructure programs. You know, the federal government may spend the money, may enact the money, but it's actually spent by the states, and they have to go through the environmental impact statements and the zoning requirements and the contracts and so on. So it takes 2 or 3 years to really get geared up. In 2009, after those so-called shovel-ready projects, 2 years later, only 30% of that money had been spent. But the point is, I think there's a lot of pressure for them to show enough progress by the election next year that voters are going to say, yeah, okay, these guys are doing something for me. They won't have much in the way of results in job creation, but I think they'll get their act together. The thing about Congress is that they hesitate on doing anything. Look at Social Security. I mean, they should have done something on Social Security and Medicare the day the post-war babies were born. You know what was happening. That's pretty easy prediction. But they have hesitated. That's the way they have. But that they tend to do the necessary when forced, and maybe that's brinkmanship in a way. But I rather suspect they'll be trying to get their act together before the election next year.
And one of the things that surprised me in your latest research note was your prediction that despite the fact that we're still in the age of deleveraging, 2% growth, you think the economy will accelerate to 3 to 3.5%. What drives that?
Yeah, well, that's his massive fiscal stimuli, and I think there's plenty of resources to do it. Now, some people say, well, productivity is low, and you don't have enough increase in the labor force, but productivity is very funny. It doesn't react to capital spending. If a big capital spending does not necessarily give you productivity growth. But what does is the aging, the maturation, the growing in sizes of new technologies. and you look at things like robotics and biotechnology, or maybe even self-driving vehicles, they start very small, they grow like topsy, but they finally get big enough to drive the productivity needle. So I think that's coming. And the other, in terms of manpower, the reason the unemployment rate is where it is now is not because of increase in employment, it's because people dropped out of the labor force. The unemployment rate is a ratio of people actively looking to work to, and the denominator of those people was those with jobs. Now, if people drop out of the labor force, as they did, a lot of people didn't think they could find jobs. And of course, the post-war babies, some of them retired, and younger people stayed in school. They thought they'd get better jobs with more education. We had a tremendous decline in what's called the labor participation rate, the percentage of people who are either looking for work or actively employed. A lot of those people are now coming off the bench. People over 65, their labor participation rate's going up. A lot of them don't have the money to retire, they were lousy savers, but also they're in better health and they want to stay active. And then you look at it on a global basis, boy, there's plenty of capacity in labor. So I don't see any inhibitors to that growth, and I think the fiscal stimulus is going to be the driving force on the demand side.
Let's talk more about jobs and wages. Lots of people are concerned that the Fed is already behind the curve. They don't see the pressure building up. Unemployment is low. Wages are going to accelerate and cause inflation. You say that that's dead wrong.
Yeah, I think that's true. I think the Fed itself is, of course, of this conviction that wages are about ready to explode and create inflation. But in our latest Insight, a monthly newsletter, I talk about this. I talk about all the factors that are there. Globalization. Again, you've got to look at these things globally, not just in the U.S. And assuming Trump doesn't build a wall completely around the country, a protectionist wall, you have to look at this in the availability of labor and productive capacity on a global basis. Within the U.S., as I mentioned, there are a lot of people who dropped out of the labor force who are coming back. And then you have other things that are pressing wages. The jobs have been created in this expansion have been in low-paid industries, leisure and hospitality, room clerks, people, maids in hotels, waiters, and so on. They haven't been in manufacturing and the high-paid areas. And unionization, in the private sector has virtually disappeared, and even in the public sector, it's under fire. And union workers tend to get paid more than non-union people. You've had a number of factors that are depressing wages, and then you haven't had the big productivity growth yet. And I think employers basically say, hey, I'd love to pay more, but if you don't have the productivity, people aren't producing more per hour worked, how can you pay this without it coming out of profits? And of course, a lot of them say we can't raise wages, we can't raise prices. That's the alternative because of the domestic and international competition. So I think you've got a lot of forces which are holding down wages and are probably going to continue for some time.
And a lot of people argue that with immigration slowing and population growth slowing, that the potential growth rate of the economy is at best 1% to 2%.
Yeah.
You're saying there is a lot of slack still in the labor market that's not captured in that.
Yeah, and one of the things, Henry, to keep in mind, that the easiest forecast is the projection of whatever's happening now will last indefinitely. Because everybody says, oh, right on, brother, that's what I see. You're absolutely right. And the easy forecast now is slow growth forever. And, there are the people who say that everything that could be invented that's going to move the productivity needle has been. Kind of a modern Malthusian area. Others say, well, the labor force restrictions, that we just don't have the population growth. But even our calculations are, even without a lot of these people coming off the bench who dropped out of the labor force earlier, and they are starting to, that there's just going to be enough natural growth in the economy in terms of labor force that if we have reasonable productivity growth, we can have 3.5% real GDP growth, and that's almost twice what we've had so far in this expansion.
And yet, you still think that even in that environment, stocks will not do particularly well.
Well, stocks are expensive, by any measures. And you look, one of my favorites is Bob Shiller's 10-year, cyclically adjusted PE, if you will. And of course, a lot of this is dependent on history. But if you look at the historical level of that, and this is over a 10-year period to iron out the cyclical movements. If you look on that, stocks are about 40 40 to 50% higher than that long-term norm. Now, you can say that long-term norm is no longer applicable, but I think if you look at it, stocks in a lot of ways, they are expensive, and so it doesn't say that they're going to fall apart, but it just says they're starting at a high level. You know, if you look long-term in terms of stocks, I mean, you start with the economy, and then you look at corporate profits. Corporate profits grow about in step with the nominal economy. They almost have to. You can't see profit share either going up indefinitely or down indefinitely. So then the only difference between stocks and, in effect, the growth in the nominal economy is the price-earnings ratio. Is it going up or is it going down? And it's cyclically going up, and I think it's probably cyclically going to go down. So I think that even with resumption of reasonable growth, you can't expect a kind of, you can't expect double-digit stock gains or 20% like we had 5 years back to back in the 1990s. That, you know, as they say, trees don't grow to the sky.
And you've been very clear in saying bull markets don't die of old age. And as we all learned in the 1990s, they can last a lot longer than everybody thinks. That seems to be playing out now. But what is it? What would trigger a correction or a sideways movement?
Well, there are two things, at least in the modern era, which have brought bull markets to an end. One is a shock. And we saw that in the late 90s with the dot-com blow-off. And then again, we saw it in the mid-2000s with the subprime mortgage collapse. You can have that kind of a shock. The other thing, and there may be a shock out there. I mean, you know, I've been looking for much lower oil prices. That could be enough of a shock because there's a lot of heavy leverage among energy companies. Or you could have a blow up in the Middle East. You name it. You know, some kind of shock. The other thing that has ended it is the Federal Reserve tightening, and the Fed. They start, when they see what they think is an overheating economy, they start to tighten. Now, they don't intend to precipitate a recession, but by my count, in 11 of 12 tries in the post-World War II period, they've gotten a recession. Only one soft landing in the mid-90s. Now, on top of the Fed's normal raising interest rates that they're doing, they're now trying to unwind this quantitative easing, this huge balance sheet. They've never had that before. And given the lack of success they've had just using conventional monetary policy interest rates, when they put on top of that trying to unwind that balance sheet, what are the odds that they're pulling this one off without a recession? Now, that doesn't mean the recession is in the immediate future, and the Fed and the other central banks are being very, very careful because they had this taper tantrum. You remember in 2014 when Bernanke talked about simply reducing the quantitative easing, and the markets really reacted violently. So they're trying to do it very, very carefully. But, you know, sooner or later, if we don't get a shock in the meanwhile, the Fed will do the usual job. Now that could be years down the road, though. This is not an easy forecast in terms of timing.
So stocks uncertain. You still have a startling prediction for bonds, which is that the 10-year will go to 1%.
Well, you know, Henry, I started in 1981 when the 30-year bond yielded 15.2%. I said we're entering the bond rally of a lifetime. It's now 2.8%. I think it's headed for 2% and the 10-year for 1%. Now I say, why do I say that? Well, you have a safe haven effect of treasuries. You know, when the world is in trouble, even if we start the trouble, treasuries benefit. It's interesting because they are a safe haven. Secondly, I think we're more likely to see deflation than inflation, and that's very favorable for treasuries, lower yields, higher prices. And the third thing is that treasuries now, low as the yields are much higher than they are in almost any other industrialized country. You look at Germany, you know, their 10-year yields are below 1%. And so foreign investors have an advantage in investing in treasuries. They get a yield spread. Of course, they have the dollar to worry about, whether they hedge that or not, but there is a distinct yield spread for foreigners between their own sovereigns and U.S. treasuries.
You said something very interesting about online shopping, which is, as Amazon grows and others having a complete demolishing effect on the rest of the retail base. You said that in retail stores, 30 to 50% of purchases are impulse purchases, and these don't happen online?
Yeah, that's a very interesting aspect of this because you can say, well, sure, the bricks and mortar retailers may suffer if people shift to online, but if they're spending the same amount, what's the difference in terms of the overall economy? Well, the point is that there is this much greater impulse buying, and that's what stores count on. They get you in there. Hey, I go into Costco occasionally. I go in for 1 or 2 items. I came up with a whole cart full. I mean, I'll tell you, I'm exhibit number 1. And there is this impulse buying, which is very much catered to. Now, the Amazons of the world, they're trying to do this. They say, you order something, have you thought about this, or here's something related to this, but they do not, thus far, nearly have the reaction to that. So there is that aspect, and of course, this is deflationary. It's very much so, because the cost of delivering this stuff from Amazon is very different than bricks and mortar stores. And then you say, what are they going to do with all the retail space? And we've been interested in some of the second and tertiary malls from the downside, because they're folding, and in some cases the mall owners are just giving the keys back to their lenders.
And you talk about that being deflationary. You also point out that the inflation statistics that everybody looks at may be actually inflated by owner equivalent rent. I thought was very interesting.
Yeah, well, that's a kind of a tricky process, but it's a way. How does the government account for houses that people own? And they used to, years ago, they would treat it, the houses of the actual sale price as part of the consumer price index. Well, they said, well, there's so few people are involved there that isn't realistic. So then they went to what's called owner's equivalent rent, and here it is. It sounds fictitious, but there's a logic to it. They assume that you and I, if we own our house, that we rent it from ourselves, and that is called owner's equivalent rent, and it's about 25% of the consumer price index. Well, the rents that they use are based on houses that actually are rented, and rents have gone up tremendously recently, as you know, because people are renting rather than buying houses. So if you take that out of the CPI goes from, I think, year over year 1.7% to 0.9%, just taking that out. Now, you say, well, should you take it out? Well, I don't know. I don't think most people. I don't think about renting my house for myself and say, "Boy, am I paying a huge rent?" And then turn around and say, "Boy, am I getting a huge rent?"
So, in summary, the age of deleveraging was right 7 years ago. Here we are. Everyone now thinks it will continue forever. You say that is the mistake that we make, and what we're going to move into is very rapid growth, the economy, faster than people think, but that will not be good for stocks, and it will be good for bonds.
I wouldn't say it'll be bad for stocks, but I think that we may not see quite the exuberance that we've seen in the past, and this is probably going to take some time to develop this rapid growth.
So we have a few more minutes with you. Love to talk about some other topics. Bees, for example. You say that the Shilling apiaries, your bee colonies, you just harvested the honey. Now it is time to medicate the colonies. Can we talk about bees for a second? What does that mean?
Well, of course. Well, honeybees have been beset with a number of diseases and pests in the last 2 decades. Matter of fact, there are very few, or surprisingly few, amateur beekeepers left anymore, because people usually, they open the hive once in the spring and see if everything's okay, and then take off the harvest in the fall. Now I've got to be in that hive at least once a month, and this time of year more frequently than that. And I treat for 7 different maladies, and we just took off the honey. I do that in early August to get these treatments on before the bees go into their winter cluster. I'll explain that in a minute, but the idea is that I want to get the honey off that we're going to eat before I put these medications on. But there are all kinds of things. There's a parasitic mite called Varroa, V-A-R-R-O-A, that hangs on the bees and sucks out their juices. And if you don't treat that hive for Varroa, absolutely guaranteed, positively it'll be dead in 2 years, no exceptions. And then there's a bee diarrhea, and there are a couple of bacterial diseases and some viruses and so on and so forth. And interesting enough, though, bees are not going to disappear from the earth. There are 2.7 million honeybee colonies in this country today. 2 years ago, there were 2.5 million. So they actually have increased, but it's getting much more expensive and time-consuming to keep the bees alive and producing.
And you also mentioned this fascinating thing that the hive and colony over the winter is just women. Because the men in bee society actually don't have to do all that much.
Tough break, guys. No, you have 3 castes of honeybees. You have the queen. And she is a complete female. She's just a laying machine. A good queen can lay 2,000 eggs a day. In the hive right now, there are 50 to 60,000 bees in a good hive. She's a laying machine. Then the worker bees are incomplete females. They do all the work. They gather the nectar, they process it, they feed the queen, they guard the hive. They do all the work, but they cannot reproduce. Then you have the drones, the males. They can't sting. They don't clean up the hive. They don't go any work. And the only thing they do is mate with the queen. And when she mates with a dozen to 20 of them. That's the way of avoiding inbreeding. And the ones that fly the highest and the fastest get to mate with the queen, and they promptly die, after they mate, with big smiles on their faces. Anyway, but the thing is that a drone has no father. A drone is an unfertilized egg. If a queen drops an egg and does not drop a sperm on top of it, it turns into a drone. If she drops a sperm on top of it, it turns into a female worker bee. So as long as the queen has eggs, she can make all the drones she wants. So at the end of the season, the worker bees, and I've seen this, they literally drag the drones out and push them over the edge of the hive. I mean, they're not going to carry that baggage through the winter. Because see, honeybees are off in the old world. There's lots of new world bees, wasps, yellow jackets, hornets, bumblebees, and so on. They hibernate. They only make enough honey to feed their larvae. Honeybees don't hibernate. They're all from the New World. They came here with the European settlers. They call them the white man's fly, and the Indians call them the white man's fly. But they don't hibernate, so they're in the hive in the winter. Now, if you're in the hive in the winter, you got to keep warm, and to keep warm, you got to eat. And that's why they have honey. They thought it was because you like honey, right? No, they're making honey to get through the winter. Now, they're working fools. As long as there's nectar and a place to put the honey, they'll make more than they need, and that's where we come in. In this climate, this New York area, they need about 60 pounds per hive to get through the winter, and we take off the rest. But anyway, they are in that hive in the center, and they're in this cluster, bisected by these frames. They're eating their way through that hive, and the colder it is, the tighter that cluster is to keep warm.
You mentioned in your recent note, you recently had your 80th birthday. You've had an amazing 60-year career in what you do in your own firm. It's just tremendously inspiring for all of us. From the vantage point of 80, what's your advice for the rest of us? What's important in life, Gary?
Good question, Henry. I think it's probably to keep active, to keep busy, to do what you want, what you really enjoy. We in the West believe you only go through life once. Now, other religions, other parts of the world, they have a different view about reincarnation and so on. But basically, in the West, we believe you go through life once, and so you say, well, okay, let's make it count. Let's have something that we do. And I think anybody who works at a job that they don't really enjoy, not every job, not every aspect of it, for goodness sakes. You and I have uptimes and downtimes. But on balance, if you don't really like it, boy, you're wasting some precious time. The only thing you're short of in this world is time, ultimately. That's the only thing you're ultimately short of. And I think you really need to say, what am I going to do between now and death? And you can say that at age 80, you can say that at age 20. But what am I going to do in my life? How am I going to achieve what I want? How am I going to do something that is going to help other people? And I mean, I've gotten involved with a called the Episcopal Preaching Foundation. We promote preaching, Episcopal Church. It's that and beekeeping are my passions, if you will, outside of what I do professionally. But there are things you feel that you're doing something that's going to benefit other people, and you always have this ego feeling. You'd like to think that it's got some lasting effect beyond your time on this earth.
Gary, it's a privilege to have you. Thank you so much.
My pleasure, Henry. It always is.
That's it for this week. Thank you very much for joining us. Big thank you to Fidelity Investments for sponsoring The Bottom Line, and a big thank you to NASDAQ for hosting us here in Times Square. We'll see you next week.